Let's jump right in. When you hear the phrase 30-year mortgage, you probably picture the classic American dream, right? A nice front yard, a white picket fence, and that feeling of long-term financial stability. It's totally marketed to us as the ultimate life milestone. Banks celebrate it, real estate agents love it, and buyers feel this huge wave of relief the second they get approved. But today, in this explainer, we're going to pull back the curtain on a very different reality. We're going to look at the math the lenders really hope you ignore. Imagine walking into a bank, borrowing $300,000, and then finding out you have to pay back more than double that amount before you're actually debt-free. Honestly, is your mortgage a scam? If anyone else pitched you a deal where you end up paying double for an item over time, you'd probably laugh right in their face and walk out. And yet, millions of people willingly sign up for this exact financial setup every single year. To understand why we do this, we really need to look at what's actually happening behind the scenes. You think you're buying a place to raise a family, paint the walls whatever color you want, and build stability. But the bank? They're looking at a completely different picture. The bank isn't selling houses, they are selling debt. The longer you stay in debt, the more money they make. That's exactly why lenders always highlight that low monthly payment. They want your eyes glued to what you're paying today, absolutely ignoring the enormous total amount you're on the hook for over the next 3 decades. So let's dive into the shocking math nobody shows you. We'll break this down using a real-world case study of a $400,000 home purchase, because once you actually sketch out the numbers, that whole illusion of an affordable monthly payment just shatters. Say you buy a house for $400,000. You do the responsible thing, you put 20% down, which is $80,000. That leaves you with a total loan amount of $320,000. Let's assume a 7% interest rate spread out over 30 years. Your monthly principal and interest payment comes out to around $2,129. At first glance, that seems like a perfectly manageable monthly expense, right? But here's the catch. Over those 30 years, you are actually going to pay a staggering total of approximately $766,000. You borrowed $320,000, but your wallet will be drained of nearly $800,000 by the time you finally get the actual deed to your home. The shocking part is that more than $446,000 of that goes straight to interest. Seriously, let that sink in for a second. You pay the bank significantly more in pure profit than you originally borrowed for the house itself. You essentially bought one house for yourself, and you bought a whole second house just to hand over to your lender. This brilliantly illustrates the whole illusion. Just compare your original loan to that massive mountain of interest and your giant total repayment. If a car dealership tried to charge you $70,000 for a $30,000 car, you'd walk away instantly. You'd call it extortion. But because mortgage payments are stretched out across 3 entire decades, this massive, life-altering cost becomes completely invisible to the average consumer. We've normalized it just because it happens in slow motion.
Which brings us to the amortization trap.
Now here's where things become expensive. To figure out why the first few years of homeownership feel like such a financial trap, we need to understand the hidden engine running your mortgage contract. It's called an amortization. This is a loan repayment system where your early monthly payments heavily favor paying off interest rather than actually reducing your principal balance. You might look at your $2,129 payment and assume you're aggressively knocking down your debt every month. But in reality, in those early years, only a tiny few $100s is actually going towards your principal. When you make those very first mortgage payments, the bank takes a massive slice right off the top for themselves. That giant chunk is pure interest. And what's left over for you? Just a microscopic sliver of equity. Month after month, year after year, the bank makes absolutely sure their profits are secured way before you make any meaningful dent in your actual debt. Watching this trap play out over a 30-year timeline, it's easy to see how the banks always win. In year 1, the bank gets paid first. By year 10, your progress is still painfully slow. Honestly, so many homeowners are completely shocked to find out that after a full decade of never missing a single payment, they still owe almost as much as they did on day 1. It really isn't until year 20 that you hit a tipping point for your equity, and finally, at year 30, the chains are broken.
This phrase sums it up perfectly. The bank gets paid first, and you build equity later. Think about this for a moment.
The entire system is deliberately designed to secure the lender's profits long before you truly own your home. They front-load their wealth building, and your wealth building gets pushed decades into the future.
Next up, let's talk about the hidden opportunity cost.
This leads us to a huge revelation. What most homeowners never realize is that the biggest danger isn't just the sheer volume of interest you pay, it's the wealth you are prevented from building. Imagine that $446,000 of interest just catching fire and evaporating into bank profits. Now compare that to a soaring stock market. If you had taken that exact same money and invested it into a diversified portfolio over those 30 years, historically, it would have generated massive compounding returns. That money could have easily grown into millions. That is the true hidden cost of long-term debt. Every single dollar you sent to interest is a dollar permanently robbed of its ability to grow and work for you.
Because of this, we've got to change the questions we ask ourselves. Instead of just blindly comparing your monthly rent to a monthly mortgage payment, ask yourself, what is the total financial impact of this decision over 30 years? When you zoom out and look at the macro picture, you stop playing the bank's game and you start playing your own.
So what exactly do smart homeowners do differently?
The crucial takeaway here is learning how to beat the bank at its own game. And you can do this using 3 actionable, mathematically proven strategies. First, smart buyers buy way less house than they're approved for. Remember, the bank qualifies you based on what you can barely survive paying, not what helps you build wealth. A smaller mortgage gives you financial breathing room. Second, they aggressively make extra principal payments. And third, they religiously evaluate the total 3-decade cost, totally ignoring the distraction of the monthly minimum.
Let's zoom in on that second step, because the impact of extra payments is wild. Thanks to how amortization works, throwing extra money directly at the principal completely bypasses the bank's interest trap. Just one extra principal payment a year can literally erase tens of thousands of dollars in interest and cut entire years off your debt timeline. You are essentially stealing time and money right back from the lender.
Look, the 30-year mortgage isn't inherently evil. It's just a tool. It can build wealth or it can quietly drain it. The danger isn't borrowing money to buy a home. The danger is letting the bank distract you with a tiny monthly payment while they drain your lifetime wealth. Wealthy people focus on the total cost, and that single shift in perspective can save you hundreds of thousands of dollars. So I want to leave you with this final thought. Before you sit down at that big mahogany desk and sign your name on your next 30-year mortgage contract, stop asking if you can afford the monthly payment. Look at the total numbers over the lifetime of the loan and start asking yourself this one wealth-defining question. Can I really afford the interest?